Hi everybody, it's Mel, the scientific trader here. Today is the final and 7th webinar of the series. It's entitled Trading Journey, and the objective behind today's webinar is really to bring everything to a close in terms of what this journey is about, how it's fared, particular learnings along the way, and really kind of just where do I go from here. It's been an incredible ride with some very pivotal points along the way. So I'm hoping that today I'll be able to address everything that I want to. Clearly previous webinars have been quite long. This one is going to be no different. So whatever you're doing, it's going to be quite a long one, so I'm just giving you heads up straight away. But it's been an incredible ride. I mean, certainly when I started this in mid-March, I didn't really have an idea as to how this would play out, in the sense that I was doing this in a live environment. And when you're doing it in a live environment, you know everybody's watching you, and if you screw up big time, you're going to look like a complete dick. So you know, there was a bit of added pressure, and also because of the unknown, that when you are doing something in a live environment, there is still that unknown factor, because of the fact that results of the past may not necessarily be results for the future. And that's why when you're going to particular websites, educational websites where they talk about trading a lot, one of the disclaimers they always have is that past results are not indicative or no guarantee of how future results will be. So I decided to put my neck on a line, mainly because of the fact that I kind of felt that if I did this in a live environment, one of the key benefits for me would be the fact that I would really have to maintain a sense of self-discipline, because as you well know, when you're operating as a retail trader, one of the disadvantages, some would call it a disadvantage, but one of the challenges that you have to face is the fact that you're very much trading in isolation for long periods of time. And it's not like you're a trader who's working for an investment bank or a hedge fund, where you're surrounded by like-minded people, and there's an energy, there's an atmosphere, and there's a sense that everybody wants to be part of that achievement curve. When you're trading as a retail trader, as a lone ranger, you don't really have anybody watching over your back, and so if you don't have strong self-discipline, you can be very much susceptible to some of the key things that plague traders when they're in isolation and, you know, trying to cut corners or do things that you wouldn't necessarily do if somebody was kind of watching your performance over your shoulder. So this may have been a learning journey for some of you, may have been quite educational for some of you, but certainly for myself it's also been of great benefit as well. So I've entitled this webinar Trading Journey, and it's packed with a lot of stuff, so I hope you enjoy, and let's get things cracking. So the first slide is actually showing you an image of the alpha helix structure of DNA, and one of the reasons I've put this slide up is some of you who may be coming from a scientific background may remember, I believe it was in the late 90s or the early 2000s, when scientists actually completed a quite a lengthy task. I think it took over, I don't know if it was a decade or 2 decades, but it was certainly a long task, where they were attempting to basically decode human DNA in terms of the base sequences, and it was something that took a long time. But when they did achieve that task, what it essentially did, it gave the foundation to the scientific community to then look at possible ways that they could then use gene technology, various modes of genetic engineering to treat disease, to uncover disease, to profile disease in a much better way, in a much more efficient way, so that treatments could be more tailored, rather than having sort of like this sort of generic treatment program, when it could be the case that particular diseases seem to mirror certain base sequences which seem to be conveyed within particular, ethnic populations or particular demographics. And so the whole sort of unraveling and base sequencing and decoding of DNA was quite a momentous occasion within the scientific community, really because of the potential it would bring. Now, whether we've realised that potential now is open to debate, but certainly I know that there are companies now where you can pay hundreds of pounds for them to do a very sort of in-depth medical check, where they can do it much more insightful than what you would normally get from like your GP, who would just do a urine test or a blood test. These are tests now that are sort of going down to various levels, where they can identify, patterns within your family history and identify things that normally wouldn't be uncovered by just a quick trip to your local GP. And the reason that I've kind of used this image as I've used this really to represent the fact that the strategy that I've been working on for many years, late goals, I believe I've actually reached a stage now where I've completely sort of decoded it. And what I wanted to do today was just explain how I can justify that statement. But certainly there were some things that I uncovered in the month of June when I was doing some sort of like a midterm review, things that I removed in terms of Deadwood, and certain angles which brought new light to me. And this is something that only comes with sort of intense levels of data mining, data manipulation, and really drilling down at a real micro level to really uncover things that wouldn't sort of be normally visible to somebody that's just looking at late goals from a kind of more macro view. So the alpha helix here of DNA is how I kind of convey my sort of decoding of late goals, because late goals, just by sheer title, if you were to go to a list of games on a Saturday or Sunday and just decide that you're going to sort of adopt a strategy of doing late goals for every match, then you'd probably be at the poorhouse quicker than you think, because it's not as simple as just number one, we need to define what we mean by late goals. And for me, my definition of late goals is anything from the 83rd, 84th minute onwards. Some people may define it as goals within the 70s, 70th minute to the 79th and beyond. But for me, there are reasons which I will expound on. For me, late goals is, when I say late goals, I mean late goals. I'm talking not even the 80th minute, 81st. I'm talking 83, 84, 85 minutes onwards. But I truly believe that there's just been a tremendous exponential increase in terms of my understanding as to some of the behaviors, some of the momentum factors that drive late goals. And I've kind of got to the stage now where it's the methodology is just sort of fully in sync. And if I did have any particular sort of minor feelings of fear or concerns about the methodology, they've just totally been blown away now. I completely understand exactly how this operates. So what I wanted to do was just give you what were my reasons for this project. And this is quite interesting and quite important, because obviously different people that come onto Twitter or come to the website or come through watching the webinars on YouTube, there have been some questions about, why are you doing this? And I would say these are some of the key reasons. So number one, it was really to attempt to transition a common approach found in financial technical trading over to speculating in sports. Now, I've kind of alluded to this in previous webinars that much of what I do and try to do has been heavily influenced by what I've seen within financial trading. Now, financial trading is quite a broad term, and that really covers a wide spectrum of different asset classes. So whether we're talking forex, whether we're talking equities, whether we're talking penny stocks, whether we're talking derivatives, commodities, bonds, even the indices themselves, cryptocurrency. So when I'm talking about trading, financial trading, I'm talking about a certain type of technical trading which actually is quite apparent across different asset classes. And that technical trading is one which really, I suppose my advantage was that even though I was really hopeless at math when I was young, it was statistics that really grew on me and something that I excelled in. It was quite interesting actually, because normally when somebody's good at math, they're good at math, and if they're hopeless, they're hopeless. But with me, I was hopeless at math apart from statistics. There was something about statistics which kind of resonated with me in terms of me being able to really pick it up quite quickly. And so when I was sort of musing within the financial trading space, so when I was actually sort of musing around within sort of financial trading, it became quite clear to me how important a statistical and probabilistic approach was, especially for technical traders. And obviously, if you're quite familiar with trading in the financial space, you'll probably be quite familiar with terms like fundamental trading, technical trading. But certainly as far as technical trading, so what I was trying to do was take some of these concepts, some of these building blocks that I'd sort of amassed in terms of my understanding, and try and see if I could kind of replicate these ideas within sports, certainly within football. And so what I was trying to do was really just show that a systematic and probabilistic approach is very effective in rapidly building income whilst minimizing volatility. And this is quite key, because there are obviously, amongst the huge amount of football trading systems and betting systems which are just a complete waste of time, there are a minority of systems which do work. But one of the things I noticed with them is how slow they were in building income. I mean, there were some systems that I saw where, they were talking about if you start with £10,000 in your bank, growing it to over £20,000 within a 12-month period. So they're talking about 100% increase in 12 months. And I was like, well, good God. I mean, if I wanted, so you're saying that if I wanted to earn an income of 50 to 100k from trading, I would literally need to have a bank which is actually £100,000 or more. And I just thought, when is that ever going to happen? And also what I found as well was that some of these systems had really scary, they were really characterized by some very scary levels of variance and volatility. I mean, volatility and variance is obviously something that you just can't run from, because that's part of, statistics anyway. But there were some systems where it was swinging up and down like a yo-yo, and whilst the ultimate trajectory was one that was going north, I couldn't help feeling that some of those types of systems and tipping services are like being on a roller coaster ride. So for me, it was very important to find something where minimizing volatility was quite a key part of, or quite a key feature of the strategy. And another reason for the project, as I've alluded to, is really to contribute towards my self-discipline, because I had terrible self-discipline many years ago. And as I've alluded to in one of the webinars, I believe that is something that's sort of followed me all through my life and stems from childhood. It's a particular character flaw. So coming into trading, and the thing about trading is it really does uncover every weakness and vulnerability and character flaw that you have. It's like, a water leak in a house. Eventually it's going to find every single opportunity to fill up whatever space is available. And so with trading, for me, this project I believe would help my self-discipline, because it would mean that, because I knew that I was publishing my results every single day, that the public jury would be out in terms of people watching my results. So it was very important for me not to have any relapses into revenge trading or over trading or sizing up too much, and really being able to maintain a very, very level head and a very level-headed sense of focus, because ultimately the end goal was that when I get to the end of July, I wanted to be able to demonstrate that the particular methodology I'm following is sustainable, it's profitable, and it mirrors all of the characteristics that I wanted it to mirror. The reasons for the project, the results are, some people have said, why are you doing results? And I used to go into different forums under different names, because what I was trying to do was play devil's advocate and kind of test the market, test opinion, and really just test what people's views are. And I very soon got to realize, forums are normally run by oracles of truth. So these are like gatekeepers that sit there and want people to follow a particular way of thinking, a philosophical way of thinking, and anything that kind of acts as sort of interrupting the flow or disrupting the flow is dealt with harshly by the forums. So it was quite an interesting experience. I mean, some of the times I was quite provocative, because there was a reason for that, because obviously I'm trying to kind of really find what is the root core why people believe what they believe. And so it was quite interesting. But I remember one of the questions I was asked was, well, why do you want to show results? And it was quite interesting, because within the financial trading space, showing results is the norm. There's a lot of platforms where traders, professional traders, retail traders actually upload their results every day, whether it's profit.ly, my FX book, Zulu Trade or eToro. I mean, these are all examples of where thousands and thousands of traders are actually uploading their daily results. And the reason for that is to help others learn in terms of how well a strategy is doing, the life cycle of a strategy, understanding, the win rate, the reward to risk. So this was the environment I was coming from. So I was quite shocked to come into sports, and all of a sudden it's like, no, you're not supposed to show your results. I'm like, for crying out loud, like, what's the issue in showing results? People are like, well, results could be fabricated. And I'm like, well, somebody wants to fabricate results, they're fooling themselves. But if you want to show your results in a transparent way, what's the problem? And I kind of think sometimes that this issue of, oh, you shouldn't show your results is something which provides a great cover for people that speak a lot, but don't actually practice what they preach, or who are talking all the theory but their daily trading results do not mirror at all the effectiveness by what they preach. So for me, I kind of felt, let me show my results, let me show the good, the bad and the ugly, because at the end of the day, I live or die by what I preach, and the results of my system will be a testament to that. So that's why I kind of felt, well, results are the basis by which a system is measured. So it doesn't matter what I say or you say. At the end of the day, it's just like if you're going to buy a car, at a car dealership. It doesn't matter how good the car looks on the outside. It doesn't matter, how nice the color is, whether it's sort of metallic or opaque, or whether the wheels are big or not, or whether it's got power steering, or none of that matters. I mean, because at the end of the day, the only thing that matters is, does the car work? Because if the car doesn't work, if the engine doesn't start, then everything else is meaningless. And that's the same way I kind of saw results, in the sense that me and you can have a great debate about different things about my system, or we can have great philosophical debates about meanings of various definitions, but at the end of the day, the only thing that matters, and which is the dividing line between those that actually perform and those that don't, are the results. And some people don't like that. They don't like when I throw the results at them as my defense, but that's because they're either being ignorant of the fact that what I'm doing works, or it's the fact that they're not actually performing themselves, and so seeing somebody else that does obviously causes them to flare up even more. Ultimately, one of the other reasons for the project was really to provide hope to those who are fed up with the same old betting trading approaches that don't work, or are too volatile, or too slow in building equity. And it's quite interesting because over this journey, I wouldn't say a lot, but there's been a few, probably less than 10, I would say, to be honest. There have been probably about 8 or 9 people that I've built very, very good, solid working relationships with, in the sense that they were people that were just completely fed up with year after year following different betting approaches that just didn't work for them. Now, sometimes things can not work because of either it's something that doesn't resonate with who you are as a person, or it could just be the fact that the system or the strategy actually is flawed anyway. And only you and me can be the ones that know that when we're actually working on something. But certainly there's been quite a few people that have said, you know what, we're going to forget everything we've learned, and we're going to just follow what Mel has said. We're going to look at his webinars. We're not going to jump into any conclusions. We're not going to start we're not going to start listening to webinar 5 and not starting at webinar 1. We're not going to start jumping to conclusions. We're not going to start fussing about little silly things that Mel said this and Mel said that. We're just going to be an empty sponge and try and see if this thing works. And what's been quite interesting is that there has been a few people that have contacted me to say that they cannot believe it, that after 7-6 years of betting and year after year not making money or breaking even, they are completely astounded by the results that they're getting. Now, I've obviously said to people, don't judge things by 1 month or by 100 trades. You really need to just have a sense of caution, because you don't really start to see the true nature of what you're doing until you start hitting 200-300 trades. But certainly there are people that have actually seen that some of the fundamentals I talk about do work, but you've got to be open. And if you're coming in with all kinds of preconceived ideas, and especially people that have been burnt so badly that they're simply just negative about everything that they see, then you're not going to see it. But those people that have the vision to see what I'm talking about and have the tenacity to put it into place and the ability to basically leave everything that they've been taught at the door and take on a probabilistic mindset, those are the ones that are probably going to start to see results moving forward, because they're the ones that are going to painstakingly go over everything that I've talked about. They're going to appreciate that there may have been errors in what I've said, but their focus isn't about being nickety pickety about this and that. It's about understanding, okay, what is generally the point that Mel's trying to make here. Those are the ones that will succeed. And I've been really heartened by some of the emails I've got, and I've said to them, I said, don't bother do what I did, where you set up Twitter and start sharing your results, because at the end of the day, there's no need to, because you're simply just duplicating something which I've already done. Just keep it to yourself, enjoy it, start enjoying the profits, and just know that you've got something that can actually feed you for life. And why waste time putting it into the public domain only for people to then start moaning about it? So it's been good for me knowing that there are people that actually have put things into practice and are actually seeing the results, and it's working for them. So the equity curve here, and just a reminder, somebody came on my Twitter account the other day arguing about what equity means, and I couldn't be bothered to explain, so I said, well, here's my equity curve. And he goes, well, you've just proved my point, you don't know what you're talking about. And I'm like, well, it's called an equity curve, so what is it trying to convey? If it's not equity, why is it called equity curve? But anyway, I mean, those are the sorts of people that you just can't be, they're energy drains, and it's important not to get into a lot of conversation with energy drains, because they drain your energy. But basically, this is the life cycle of the journey, which actually started mid-March and went on to the end of July. Now, there's a number of sort of key visuals that I wanted to kind of go into detail around. One of them is, I think there were 3 particular points in the journey where there were a period of flatness or sideways motion as far as the equity curve is concerned. This first one here was around Easter time. So I started a project and then ran into the fact that Easter was coming up, and over Easter I think there were like 7 or 10 days where I didn't trade. So that explains why you see this sideways motion here. The next sideways motion was here, which was around the end of May, beginning of June, where I was away, I was abroad, and so I didn't get to do much trading in that week. And then the last sort of I wouldn't call it sideways, it is actually slightly declining. This was for the month of June, and I think I talked about this in webinar 6, where in June I just come back from being away, only to be ambushed by a particular web development project which I completed. Then the World Cup started, and I just found it was very difficult to maintain my level of focus in June. I mean, the World Cup, I think it was the first World Cup where they were having like televising 4 games per day, and watching 4 games a day, because obviously I work from home, watching 4 games a day, and so I just found that my energy, my focus, and I got involved in some tasty conversations with people, and when it got to the end of June, I just said, you know what, I've got a month left, let me just reset and let me get back to the type of mindset I had. And that's why it's just amazing when your mindset, when you at a subconscious and conscious level, when you make a determined effort to kind of reset yourself, it's amazing the impact it has on performance. Because for July, this is what's happened, and it's been upward sloping equity curve. So overall, there were I think in total there was about 135 trading days, and I think there were over 400 trades, or close to 500 trades, because I was normally trading about 4 to 5 times a day. So the overall profit made, so you've got to remember my initial bank was £5,000, but overall my profit was close to, well, it was just over £14,500. So if I'd kept all that profit in my bank would then be sitting at about 19.5. But unfortunately, I was dipping in because I need to eat and survive, and there were some other sort of things I was doing where there were cost implications. So I was having to draw my profits out every so often. But this is the equity curve, and this is how it looks. It's an upward sloping equity curve. Now, there are some other key things I just wanted to talk about, in terms of the fact that what you'll realize is that the equity curve doesn't just go up in a straight line. There's going to be periods of pullbacks. So pullbacks are sort of days or clusters of days where there were losses, but ultimately the overall momentum and the overall trajectory is one that is still going upwards. But just be mindful that there's pullbacks, then forward motion, pullback, forward motion, flat period, slight downside, forward motion, and then you get these periods of consolidation. So it was important to sort of understand the sort of life cycle of an equity curve, because certainly back in the early years of me as a football trader, I wouldn't have lasted this whole life cycle. I would have, as soon as I started hitting periods of pullbacks, I would have thought that something was wrong with my strategy, not realizing that this is the actual nature of an equity curve, in terms of when it comes to trading, it's never going to be just a straight line going up. So how do we sort of contextualize this? Because certainly some people might think that making £14,000 within the space of 3 to 4 months is quite good. Others might think it's just a drop in the ocean. But just to give it some sort of, just to contextualize how it's been, what I wanted to kind of equate this to what it would mean in terms of an actual salary. So I went to a website which is called thesalarycalculator.co.uk, and it's got different useful ways of being able to come up with numeric values based on what you're looking for. But one of the things I was looking for was, well, based on a salary, because over the course of 4.5 months, which is what the Science project was based on, I think I started in mid-March, so the end of July would make it 4.5 months. Well, if we take the £14,592.47 on a monthly basis, this is about £3,242.77 per month. So what I decided to do with the salary calculator was say, okay, well, if I wanted to take, in a normal job, in a normal 9-to-5 job, if I wanted to come home after tax with £3,242, what would my gross annual salary need to be? And the answer to that was actually £53,271.31. So basically, the Science project, which began in March and went on till the end of July, the performance of it mirrors somebody that would be on a salary of £53,000. And I think that's pretty good, because as we're going to see a bit later on, the way that I was operating the Science project was with the brakes on. And there was a reason for that, because what I'm trying to do is walk before I run, and I'm trying to kind of build a platform, a level of consistency, a level of continuity, because there's going to be people that are watching and probably have no idea what I'm talking about. So for me, it was important just to start off slow, some slow steps. And then, obviously now we've reached the end of July, in terms of my own personal continuation of this project, this is where I'm going to actually start moving forward big time. But what I wanted to do between March and July was just kind of give you an insight or a snapshot of how a project can start off in a very slow, methodical manner, but one whereby you can clearly see that there's improvements and progress that's being made month by month. But £53,000, I mean, how many of you in full-time work would decline that if you're, I mean, obviously some of you are probably earning well in excess of that, but I know, if you take into account what the national average wage is, £53,000, I think is pretty good going. And that's what I'm earning, based on the fact that I'm doing a couple of hours of trading, per day, and one whereby I've got my freedom, don't have to report to a boss, don't have to be limited by people that want to limit what you do. So there's a freedom of expression that comes with what I'm doing. And that's why it makes me laugh when people they want to change what I'm doing and tell me that it's wrong, it doesn't work, because those are people that are exemplifying the very thing that I was running away from when I left the 9-to-5. I felt things were just so limited in terms of what I was doing. Things were so much structures in place. There wasn't really any ample opportunity for freedom of expression, and certainly in terms of the field that I was in. And so for me, just being in a job where I can just do what I want and do it as I want and nobody can do anything about it, that is just ideal for me. And when it works, that is like the cherry on the cake. This graph here is a different sort of graphical illustration of the results. This is an equity analysis, and what it's trying to show you is the contrast between profitable days and losing days. And as you can clearly see, there's a lot more profitable days than losing days. One of the big disappointments I had was that I never did actually exceed £1,000 in terms of profit. I came mightily close on day 26. Well, I think it was around 980, 970. But I didn't really come close again. Got over £600 a couple of times. But a lot of the results seem to be sort of in the region of sort of £300 to £500. What's quite interesting again about this graph, and again it's something I alluded to in one of the previous webinars, is the fact that every time I had a losing day, that losing day normally followed a cluster of winning days. And so I had this kind of analogy, and I think in analogies and visual kind of manifestations, because it kind of helps me to give myself an anchor that I can hold to, so that when things are happening, I can apply meaning to it. So one of the ways that I would look at this equity analysis graph is see it really just as a measure of cost of business. So when I had losing days, rather than beating myself up about it, what I would say is this losing day is simply the cost that I've had to pay for the profits I've accrued on the previous days, the cluster of profits I've accrued since the last losing day. So as an example, day 27 I had a loss here, but before this loss you will see that there was 1, 2, 3, 4, 5, there were 7 profitable days. So if you added up those 7 profitable days, what you would find is that they far outweighed and far exceeded the losing day. So the way I would look at it is that, well, I'm incurring a loss as the cost of business for incurring these profits. And this is something which I found happen quite frequently. So here we have another losing day, but look at the amount of profitable days I had before. 2 losing days in a row. Look at the amount of profitable days I had before. And it was very rarely, I mean, there was very rare occasions where I would have a losing day which would either eclipse the cluster of previous profitable days. It was very infrequent. I think it only happened once or twice. I mean, here, this was in June. You can see the cluster of these losing days obviously outweighed this small profitable day on day 89. And then we had another losing day before. But I could be comfortable with that in the sense that look at how small these losing days are anyway. And so there are reasons for this, which I'm going to explain. But one of the key things just to take away from equity analysis is the cost of business. And I've kind of explained it before that if you're running a business, there's always going to be cost. Even if you're running an online business where you're doing it online because you're trying to get rid of the traditional overheads that would be associated with a business that has fixed premises. Even with an online business, you're going to still have costs, whether it's online advertising, whether you're doing it through Google AdWords or Bing or various sort of second and third tier. By kind of just remodeling how I look at this in terms of losing days, it really helps to give a sense of assurance, because when you're actually looking at a losing day in isolation, one of the things you've got to remember when you have a losing day, there's a tremendous amount of emotional capital that you can expend in over analyzing and anxiety about the fact that there's a losing day. Because when you have a losing day, the next thing you're worrying about is, well, will the following day be a losing day? And the thing about losing days with me is what I have found, because I apply a battle plan approach, which again, I'll talk about a little bit later on, but it basically means if I get 3 losing trades in a row, that's me done for the day. That's like my stop loss for the day. What I've done in the past, I've actually just carried on monitoring. If I'd carried on trading beyond those 3 losses, if I'd carried on trading for the day, where would I have ended up? In the majority, I can assure you, in the majority of occasions, I would have been building myself a graveyard for that day. Because, I mean, it happened a couple of weeks ago where I kind of measured, okay, what would happen if I carried on trading throughout this day? And I think I would have hit like 8 losing trades in a row. And so even though the fact I didn't incur 8 losing days in a row, just the sheer fact that I realized that I could have, I remember it started to actually play on my mind. And you then start wondering, is my strategy broken? Is my system broken? And what if the next day the same thing happens again? And so what I find is that by having like a sort of visual illustrator like this, where you can visibly see that losing days, the majority of times, losing days are either they eclipse a real strong cluster of profitable days, or the losing day is followed by a cluster of profitable days. And so what this does, it really kind of helps to balance you. It provides a level of balance so that when you do get losing days, you can actually contextualize it in the sense that those losing days are really just cost of business, because of the fact that most of the time they don't, they're far less than the they're far less than the combined value of the profitable days that took place before it. Most of the time, I mean, obviously you can see there's a minority of times where that may not be the case, but what you're looking for is the majority, a majority denominator here, and that's what we can clearly see. The other thing I just wanted to mention as well is just bear in mind as well, and again it's something I'm going to talk about, when I was trading, most of the time I was my balance was remaining at £5,000 because I kept dipping into it. Clearly, if my balance, if the profits I'm accruing are kept in the account, so my account starts to increase, so it's no longer £5,000, it's 7,000, it's 9,000, it's 10,000, then obviously the cost, the actual levels of profitable days would obviously have increased beyond 1,000. But what happened was, because my bank was constant sort of at around the £5,000 mark, that then obviously has an implication in terms of how high your profitable days can go, because of the fact that I'm never ever sort of trading more than around 2% of my bank. Yeah. So I just wanted to make that clear, because obviously, you know, if my bank's £9,000, £10,000, then obviously the values on the left hand side are obviously going to change to reflect that. So obviously it's just something to bear in mind, that this is just kind of showing you conveying how it looks for a very limited type of approach, where I'm kind of keeping my balance constant, and so the stakes I'm using, my position sizing, is for the most part going to be constant as well, even though I'm still making a lot of profits on the side. It's just that I'm taking the profits out of my bank. Just wanted to make that clear. Kind of distill some of the key indicators which I will be following to move my Scientia project to the next level. As I've alluded to before, March to July was really kind of operating with the brakes on. So it was sort of a very steady, methodical pace to the journey. But that was really for a reason, to enable some sort of deep foundational truths to be easily assimilated. But once I hit July, it was always my intention that once I go into August, that I would start to really kind of fast track and scale up. As I've said to you before, a strategy for me is one whereby I'm really looking to be getting to the point where I'm you know, taking home minimum £10,000 a month. Now, certainly for the first leg of this journey, as we saw a few slides ago, the project was sort of averaging around £3,000 per month. So there is some way to go to get to the 10,000 mark, and that's something that I want to do sooner than later, because, you know, I've got big visions, I've got big ideas as to what I want to do, and you know, for others, you know, making £1,000, £2,000, £3,000 a month might be fine, but for myself, I've got a lot more loftier plans in store. So with that being said, there's a couple of things that I'm going to be doing. Number one is I've already started actually increasing my reward to risk ratio from around 1.6 R up to at least sort of 2.5 R. So you may remember going through the first leg of a journey from March till sort of towards the close of July, I've been following a methodology where most of the time I'm going in sort of around 84 minutes, which is allowing me to put on trades which are around 1.6 times greater than my risk. So if I was putting on trades at £100 liability, then if I won the trade, I'd be getting back £160. And this falls into line with what I've always believed about the need to have a reward which is a lot higher than your risk. However, I'm in the process of actually increasing it to around 2.5 R, which means that for a stake of £100, I'm getting back 250 or even more. And so what this basically means is that I'm making some slight adjustments where I'm now going in around sort of 86, 87, 88 minutes, whilst still being able to maintain a win rate of 50%, which is quite crucial actually. And part of doing that was because in June I was doing some very, very sort of deep data interrogation, and found that there were there was some what I call Deadwood. Deadwood just basically means things that are bringing down my positive expectancy. And there was some Deadwood which some sort of valid Deadwood that I had to remove, and by doing that, what it's allowed me to do is given me a lot more scope to maintain a win rate of 50% whilst slightly increasing the reward to risk. And what that will do, it will actually have a dramatic effect in terms of income generation, because essentially, as we saw with the last webinar, the high expectation value, which is a measure of how robust your system is, a lot of it is defined by the size of your reward to risk in relation to the win rate. So that's the first thing that I'm doing. And again, you can only have the confidence to do that if the data justifies it. If you're going to sort of if you're going to go and start a project of late goals, you might be able to comfortably put on trades up to like £50 liability in terms of trying to predict late goals coming in 87th, 88th minute. But you try and do that with over £100, and there's going to be like an inner struggle within you, because it's very counterintuitive. Because number one, you're going into a game where time is running out, so naturally you're kind of thinking, well, it's more likely that nothing's going to happen. And secondly, late goals, it is kind of counterintuitive, because if you're going in where the price has dropped, because again I normally lay, so if you're going in where prices drop to around sort of 1.4, 1.35, or if you're a backer, if you're going in where price is sort of around 3.5, 3.75 going on 4, naturally at those sort of prices, a lot of the times you're going to be thinking what you want to happen is unlikely to happen. But when you've got the data to justify it, which I've got, it really gives you a level of assurance and confidence to know that it's simply just a numbers game and that the numbers don't lie. So that's the first thing I'm going to be doing. Secondly, I'm going to start growing my bank instead of taking profits out. So with a bank of £5,000, it could have been £19,000 if I'd just kept all of the profits in from back in March. And with an account of 10,000, 15, 20,000, I mean, there's a lot of damage you can do in terms of racking up some monstrous, enormous profits. So because obviously your liability is always going to be in relation to your bank size. So I'm going to start growing my bank. So I'm going to start, if I do take out profits, it's not going to be a lot. I'm really kind of now focused on growing my bank, and any other sort of income I need, generating it from sort of additional revenue streams that I've got coming in. I'm also going to start applying a percentage-based risk management approach. So what I've been doing before is I've been sort of most times applying like a fixed risk approach, never greater than 2% of my bank, but it's been a fixed risk approach. So whether the account was sitting, regardless of what was happening, I was always applying sort of like a fixed risk. There was some sort of fluctuations from time to time, but what I've decided to do is apply a percentage-based risk management approach. So what it essentially means, if I'm doing 2% tops, then if my account is at £10,000, then it just means my liabilities will be 2% of 10,000. If my account's at £7,500, and my liabilities per trade will be at 2% of 7,500. And generally speaking, it's sort of like market knowledge that the percentage-based risk approach over the long term generates a significant more income than sort of applying a sort of like a fixed liability approach. So that's another thing that I'm going to do that's going to actually make a difference to the bottom line and to the equity curve as we sort of move forward into August, September. And the thing is, I'm completely at peace with scaling up because I'm not worried about the damage of losing streaks. I mean, I spoke to somebody the other day. He actually trades a strategy where it's his reward to risk is 1-to-1, and he has a win rate of 65%. And I remember him saying the other day that he had a day where he had 6 losses in a row, and he said that it took him nearly like 3 days to recover, the deficit of 6 losses as well as make money. And it kind of just sort of reaffirmed to me why my preference has always been for high reward to risk ratio strategies, because I know that even if I was to hit 6, 7, even 8 losses in a row, that ultimately because my reward is so much more than my risk, especially now where I'm sort of trading 2.5 up to 3.5, so for £100 my reward can be anything from £250 to £350. It just means that when I get a run of bad streaks, that I'm not sitting there worrying, because I know that all it takes is for just a couple of wins and I've either pulled myself back to evens or mightily close. And so that's the psychological strength of the high reward to risk, in the sense that when you start scaling up, the psychological baggage isn't that great, because your strength is in the fact that it just takes a couple of wins to squash a long streak of losing runs. Whereas obviously if you're trading a system where your reward to risk is virtually the same, or God forbid your reward is even less than your is less than your risk, then you're really going to be at times swimming against the tide to get back to shore when things are sort of going against you. Also, I'm going to be gravitating towards the leveraged way of trading. So I talked about leverage in webinar 4. Leveraged trading, it does take a bit of a psychological transition for me, because I've always been so used to the 3 strike rule, and so when you're moving to a 2 strike rule, it essentially means that you've got 2 trades to sort of get into the game. And sometimes that can be a bit of a psychological challenge, because when you're used to the 3 strike rule, you're used to where even if the first 2 trades are losses, you've still got that third trade to pull things back. Whereas with the leverage strategy, you're sort of going in with 2 trades to get into the game, and if you don't, you're out. But then on the flip side, it just means that when you get in a game, when your profits really ramp up big time. And I think we demonstrated that in webinar 4, where over a period of 10 weeks, the leverage strategy outperforms the sort of traditional 3L strategy many times over. In terms of moving forward, I'm also going to be ensuring access to alternative options to Betfair to address limitations and opportunity. Obviously, I've been using Bet365 as my sort of backup, where there are opportunities that Betfair doesn't sort of necessarily carry in play. But I am also, I am consciously aware that with Bet365, they could pull the plug any minute, because obviously if I'm ramping up profits on a bookmaker, you then become a sitting duck. So there are some other options that I'm looking at just to see. I mean, it's quite funny actually, because I kind of find that with a lot of the other exchanges like BetDAC or Matchbook, that their quality of trading opportunities is very poor compared to Betfair. I mean, Matchbook and BetDAQ, I don't even see much difference between the two in terms of the types of games they carry. I'd be hard pressed to find a particular time where I found something on BetDAQ that was being carried which wasn't on Betfair. But however, with Bet365, their coverage is absolutely fantastic, and so most of the time when there's potential opportunities within that I've seen, but within Betfair they're not carrying it as an in-play opportunity, 9 times out of 10 it will be on Bet365. But obviously I've got to be careful, because if Bet365 limit me, then obviously that then puts a limitation on me. So I've got to be looking for other options, and there are some other options that I'm pursuing, and I'm going to be testing them out. But ensuring access to alternative options is great, because I've just found that more and more Betfair are starting to make games either unavailable in play or unmanaged. And if it's unmanaged, then you only have access really to match odds during in play, or the other over-under goals markets are actually simply just closed from the beginning of the match. And I've even seen situations where Betfair, even the Premier League of particular countries, they haven't made in play. So I don't know what's going on, whether they don't have enough traders to actually watch and manage games for them, but it has been a bit of a nuisance, and so it's just important just to have some alternative options to take the sting out of possibly missing opportunities, because Betfair couldn't be bothered to actually carry the match. And then in terms of moving forward, one of the other things I'm going to be doing is identifying additional strategies, but strategies which are still based on the fundamentals described in my webinars. So there was something that I mentioned in, I think it was webinar 1 or webinar 2, where I talked about diversification. I think diversification is a fantastic concept in terms of having a diversified portfolio in terms of how you trade. However, I do believe that it's always great to become an expert in one thing first before bringing on additional angles and additional strategies, rather than you haven't made yourself an expert in anything and then you're tackling all of these different things, which then cause complication in your results, because you're having to deal with a different variety of behavioral performances of different trading strategies without actually understanding hook, line and sinker, how each additional one operates sort of on an individual basis as much as you can. So for me, it was always about, with late goals, pushing it as much as I can, testing it as far as I can, and really just mastering it. And then when I get to that point, then looking at additional strings that I can add to my bow. So that's something else that I'm going to be doing as well. So this is kind of moving forward and with the brakes off, and I think what will happen is over time it will actually help to accelerate my profits and kind of move me to really move me to position. I mean, ultimately what I'm trying to do is get to the point where I'm hitting £1,000 profit days more often than not, and hitting £1,000 days. Once you start hitting £1,000 days a couple of times a week, the net effect of that on a monthly basis and on an annual basis is that it really puts you into the stratosphere as far as disposable income is concerned. So these are some of the things that I need to do to kind of move things forward now quite significantly and quite rapidly, and that's what I'm going to be doing over the coming weeks and the coming months. A couple of years ago I watched a movie called Knowing. It was a movie starring Nicolas Cage, and I'm a real science fiction buffoon, so any sort of disaster movie, doomsday movie, anything to do with that type of genre, I've always had a big interest in. And there was a movie that came out by Nicolas Cage, where Nicolas Cage starred in, called Knowing. A fascinating movie for me. because again it dealt with numbers and looking for patterns, and there was a number of moments in that particular movie which kind of made me reminisce about trading, where when you're looking at doing your data analysis and you're looking for patterns and behaviors in the data flow, and you're looking for little things that can just give you that little bit more of an edge. And that's how I kind of feel my trading has developed over time, that I've been chipping away to the point where late goals has actually become a real forte, a real speciality of mine. And that's one of the reasons why sometimes people have real hang-ups about it, because, you know, when they look at the market rate is telling them that, well, in terms of when I'm going in, I shouldn't be expecting a win rate of more than 35-40%. Yeah, I'm got to, you know, have a win rate which is sort of bordering 50-55%, which makes a huge difference over and beyond what the market rate is. And this really comes down to, as I said, data analysis, understanding your data. And, you know, you can look at data first level, second level, third level. And sometimes it's only when you start looking at it, you know, to third level degree, that you start to see things that you would never have seen superficially. And that's why those people that don't really have an interest in late goals but are just trying to skirt around it will probably never have much success, because it's a lot more than just making a few predictions about leagues or teams that you think late goals will come from. It's a lot more than that in terms of how you actually combine variables together, and in terms of how you profile teams, how you profile particular situations in games, how you profile momentum indicators, and you know, even certain score lines. So it's very, very interesting to see how things have sort of moved on. And I kind of feel sometimes like Nicolas Cage, where you've spotted something but people just don't want to believe, and people just can't believe because they just haven't gone to the level of detail you have in terms of drilling. I mean, you've got to remember, this is something that I haven't just been doing this year. I've been doing it for, like, you know, 2-3 years, and it's only been in the last year or so that all of a sudden things have really started to sort of fall into place. So what is the foundation then? And this is a really good slide, because the foundation of what I believe in regards to trading really boils down to 3 key elements: reward to risk ratio, win rate, and number of occurrences. Now, reward to risk ratio I've already talked about, and I've already, you know, banged on about this till sort of like I'm blue in the face. So reward to risk ratio essentially means that you're always looking to put on trades where the potential profits are going to be greater than your risk. Within financial trading, a lot of the time this is because of the fact that if you do go for higher win rate strategies, which are like 70%, 75%, a lot of the times your reward to risk ratio actually comes down. So you know, I know people in especially in options trading, where they're putting on trades where the win rate may be 80%, but whereby they're risking, you know, £300 to make £100. And I think we've already seen, using equity curve simulators, which give you a very sort of good inclination as to the level of performance that you would expect based on whether you've got a high win rate with a low reward to risk ratio, as compared to a low win rate with a high reward to risk ratio. So reward to risk is very important for me. And as I said, part of the reason why I started this whole science journey was because I actually became completely fed up in chasing high win rate systems, because when you actually started to execute them in a live environment, they never ever seemed to live up to performance. And for me, it just got to the point where I become so exasperated that I literally decided that I had to go back to what I feared, which was dealing with a low win rate system, but then obviously realizing through lots of pain and experience that low win rate systems are actually much better than what I thought. So win rate is the second component. So you can't really talk about win rate without reward to risk ratio, and you can't talk about reward to risk ratio without win rate. It's like yin yang. They're sort of completely in sync with each other, and one depends on the other, and the value of one is based on the value of the other. So there's a dynamic relationship that exists between the two. But the third component of the third foundational component is something that's quite overlooked, which is the number of occurrences. And that essentially means, well, what are the number of trials that we're talking about here? And this became quite an important issue for me, because a couple of weeks ago I was contacted by the guy who's the head of Trade on Sports, and he contacted me in a rather bizarre fashion. I'm not going to be bothered to go into it, but he contacted me, and he was, Trade on Sports, they have a particular bias towards games where there have been goals quite early on. And what had happened was, if you actually look at my data, what I have found is that if I look at all the games that I've traded since March, 50%, I would say 50% of those games are games where there was a goal in the match within the first 20 minutes. And then the remainder 50% of games are games where there was no goal in the first 20 minutes. Yeah. So, what he asked me was, well, if the majority of my trades are coming from the first sort of 20 minutes of the game, especially if you compare it to any other sort of time interval, why don't I just focus on trading matches where there's goals in the first 20, where there's a goal in the first 20 minutes of the match? Because Trade on Sports have a number of assumptions that they make, and one of them is that in early goal games it more than likely will lead to goals later on in the game, and to a certain point I do agree with them, but there are some distinctions that I do need to make. But what I had to educate and tutor him about was, well, if I exclude the rest of my sample size, it actually will lead to lower profitability overall, even if it's the case that there may be a slightly higher win rate by focusing on goals within the first 20 minutes of a match. And this is something that a lot of people seem to forget, that your sample size also has an influence and dictates what your overall profitability is going to be. So the question I would have is, would you prefer to have a strategy which has a 60% win rate, but you only get 100, it only generates 100 trades a month? Yeah, so a 60% win rate strategy, but it only generates you 100 trades a month. Or would you go for a 50% strategy, yeah, that generates you 350 occurrences per month? And so the reason I mention that is because of the fact that you can't just look at win rate and say, well, if I look at this particular segment of data, it gives me a much bigger win rate. You've also got to take into account, well, if I do just look at if I look at this specific segment of data, what about the data that I'm excluding? What about the other segments of data that I'm excluding? And by excluding those other segments of data, am I actually cutting off my nose to spite my face? So number of occurrences is very important, and that's why I've seen it before where you could apply filter after filter after filter indicator after indicator after indicator, to the point where, according to your data, you've got a strategy which gives you 80%, 90% win rate. But you've added so many filters that your sample size, the possible number of trades you get per month, is probably not going to be no more than 50. Yeah? Great win rate, but you're only getting 50 trades a month. Whereas, you know, by going for less filters and less indicators, you know, you're going for a win rate which is around 60, 55%, but then you're able to, you know, you're able to get, you know, 200 trades for the month, 300 trades for the month. So you have to really understand the dynamic relationship between reward to risk, win rate, and number of occurrences, especially if, and again, this is another important thing. Again, this is going to come down to, well, what are your expectations? How much money do you want to make per month? You know, if you only want to make £1,000 a month or £2,000 a month, then, you know, possibly you could possibly go for a system where it's not generating many occurrences every month. But certainly if you're looking for a system where you're wanting to make 5, 10, 15, 20,000 pounds a month, and you want to do it in a way where you're not violating, you know, laws of risk management, but you're doing, you know, sort of standard risk management levels, you know, no more than 2.5% of your bank, and you're wanting to make 5,000-10,000 pounds, then you really, that will then help you to factor in the likely number of trades that you need to be putting on each month in order for that to actually take you towards your intended target. So that's just an important thing to bear in mind, which is the number of occurrences, because sometimes people will just look at reward to risk, win rate, and not factor in, well, how many, you know, what sample size is your strategy going to give you on an ongoing basis. At the bottom of the slide is a web link that I would advise you to go to. This web link is very, very, very brilliant article from Corey Mitchell, who's a renowned article writer within financial trade. He's also a trader as well. And the title of the article is How to Make 10% per Month Day Trading. And he talks about the very things I've talked about in this particular slide in regards to reward to risk, win rate, number of occurrences. So if it is something that it interests you and you want to know a bit more in-depth information about it, I suggest you go to this particular URL, because it will definitely provide you a lot more meat on the bone regarding what is a considerably important topic. So I just wanted to touch on the life cycle of the science of trading process. So if I could kind of distill it into sort of 3 key areas. First, I would say pre-match statistical analysis, which is my process for identifying high potential probabilistic opportunities. And again, everybody has their way of working. This is mine. But statistical analysis is very important for me because stats don't lie. And the reason why stats don't lie is because I've already tested. So if I was to take some of the worst leagues statistically for late goals or for scoring goals generally, which would be leagues like, you know, the Argentinian Division 1, Brazil Division 1, many of the Eastern European bloc countries have a very, very low ratio of goals, like Belarus, Kazakhstan. Even if we're looking at, you know, Spain Division 2 has a notorious record for 0-0s and 1-0s and just very low scoring overall. What else comes to mind? You know, if I was to take those, you know, those types of, I mean, even Romania Division 1, you know, if I was to take those leagues and basically run late goals as a project for a month and then compare it to running late goals another month where I'm running it on leagues like Ireland, Division 1, Division 2, most of the Icelandic leagues, most of the Nordic leagues for that region, Scandinavia, Nordic region, Holland, Sweden, Spain, Division 1. I can guarantee you, I'd put a mortgage on the line that the latter leagues would show a much, much more favourable set of results than the lower leagues. So we know that stats don't lie. And so because of that, I believe that pre-game stats, has an intrinsic value, has an intrinsic worth to it. And again, I suppose a lot of it depends on what you're trying to do. There are certain types of trading that maybe pre-game stats doesn't really have much relevance, but certainly for what I do, I've already tested, and I do realise that certainly there is a big differential between trading different types of leagues or different types of teams, because each team has particular properties, particular attributes, and you then have to marry those attributes with the opposing team, which paints a picture of what possibly could happen. Now, it doesn't necessarily have to happen, and that's the nature of football, because if it did, then we'd all be millionaires very easily. There were many times last season where I picked out certain games where you could have, somebody could have put a gun to your head and you would have said, yep, I'll put a £50,000 on there being a goal, and it ended up 0-0. And we're talking about two teams from leagues that just have a tremendous reputation for lots of goals and late goals, teams that have poor defences but score a lot of goals. So all the indicators were there, all the momentum drivers were there, but it ends up 0-0, or it ends up 1-0 with no goal scored in the second half. So I'm not saying that pre-match stats analysis is the be-all or end-all, but it certainly provides you a good foundation to work on. And then my second vantage point is in-play momentum drivers. So just because you've got a game where the stats are favourable, it doesn't necessarily always translate into that, into what you intended it to during the course of the game. And so momentum is a very big driver for me, because I'm also looking to see whether the momentum is justifying the pre-game stats analysis that I did. And so there are different ways to measure momentum. A lot of it is actually quite subjective, but if you do find a way that works for you, it becomes a very, very powerful tool at your disposal in helping to cut down on the number of losses and increase the number of wins. And if you can marry pre-match stats analysis with in-play momentum drivers, then ultimately it will just constantly feed you a continual array of successful late goal profits. And when I say late goals, again, I just want to contextualize. I'm not talking about late goals in the 75th minute, 78th. For me, late goals is contextualized under the remit of when you put on your trade, is it actually giving you a reward which is going to be at least 1.5 times greater than your risk? So, if you're thinking of late goals like 77, 78 minutes, where normally the trade-off is 1-to-1, that's not of interest to me. So my perspective on late goals is something that is certainly 83, 84. And obviously in the last 2 weeks or so, I'm now gravitating to where I'm waiting for goals in the 86th, 87th, 88th minute, which then brings a much, much bigger reward to risk ratio differential. And just by following this life cycle, again, I'm kind of pulling on some of the things that I've mentioned previously, but certainly in webinar number 1 or webinar number 2, I was talking about the process of a farmer feeding seeds, and the way that I kind of see the life cycle is that it's basically filtering, it's basically generating and throwing seeds into fertile ground. That's what number 1 and number 2 is doing. And then with number 3, all I'm waiting for is to reap that harvest. And so even if I go through a bit of a rut where I may go 4 or 5 or even 6 or even 7 trades without a winner, The confidence is there that the continual process of generating good seed and throwing good seed into fertile soil, I have the confidence and the assurance that at some point it's actually going to result in a significant amount of late goals that will pull back and squash those losses and actually give me what I need. The other thing I just wanted to add is you just have to bear in mind that probability, the way that probability works, it could actually drive you crazy if you're trying to work out how does it work the way it does and why does it work the way it was. Because certainly I've had situations where I've had 3, 4, 5 losses in a row, and but there's just an assurance that it can't just continue happening like that because of various things like mean reversion and the fact that streaks have to end. And so it's just been really interesting, my maturity over the time, because as I've said before, that it's always been a I've always just had this knack of wanting to know the nitty-gritty of how things work. And so like having a remote control, I wasn't content with just knowing that when you press the button it changes the station, but I want to sort of get into the back of it and look at the circuit board to find out exactly how it does it. And I think with probability theorem, sometimes you just have to accept it's just a scientific principle that works. It works just like the sun rising and the sun setting and it going dark and then light and the different seasons and the different aspects of the day. It's just a fundamental law. And so once you embrace it and just accept that that's how it is, rather than trying to suss out how it works, I think that's the point where you kind of feel at peace with yourself, that you don't really have to worry, because once you've done the testing, you've done the back testing, you've seen it work before, so it will work in the future. And you've got to remember, football isn't like financial, and this is one of the advantages of football, because football is actually closed in terms of the rules. The rules are constant. It just means that when you do find an edge, most of the time that edge will last for a very long time. It's not like financial trading where you can find an edge, but that edge only works because of the fact that you're actually in a bull season, and when it moves into a bear season it doesn't work, or vice versa, or the market is sort of trending sideways when your strategy is only built for a bull market or a bear market. With football, the laws of the game are constant. So when you do find patterns and behaviors and trends, most of the time they should be constant, all things being equal. Just going back to data sources. So obviously here I was talking about pre-match stats analysis. So there's many data sources that I've alluded to in the past, and 3 that I would really do like more than the others is Stats Don't Lie. Actually, I may have got that web URL wrong. I think it is the statsdon'tlie.com, foosball.webpoint.com, and the Hong Kong Jockey Club. And again, I've made mention of them a bit more in webinar number 6. So if you haven't seen webinar number 6, you'll find that I make more mention of them there, where I go into detail why I use those sources. But these sources provide me with a lot of the information that I need, and there's other sources I use, but these are the key ones for details that I outline in webinar number 6. In talking about momentum drivers, again sort of picking up on previous webinars, momentum is quite subjective, and I think with momentum you've just got to find something that works for you, because it is quite a subjective process. With momentum, the way that I assess momentum, it's because I've actually got access to BetAngel. So the trading software that I use to sort of connect to the Betfair platform is BetAngel. There's others, like Geeks Toy and others that are out there. But BetAngel is the one that I like and I use. And within BetAngel, they have a number of ways that you can display graphs, especially if you're somebody that does a lot of technical trading. And so I use there's a particular option called price envelope. So I used a price envelope. Somebody was asking about this the other day. So I use price envelope, which allows me to see price movements, so I can assess volatility, and I can put in various levels of measures, which helps me to get a firm idea as to what I believe is a potential game for more goals. As I said, it's very subjective. Somebody could look at the same thing that I'm looking at and come to a completely different conclusion. So for me, you just have to find, there's other variations actually. Another one is line charts. So here we've got sort of line charts. The line chart is another option. Looking at weight of money, where is the money is in the market. And another one is obviously candlestick. So if you're somebody that's a chartist, that especially if you're somebody that does chart trading within financial trading, software like this is going to appeal to you, because it's just going to be a seamless transition from what you were using with your brokerage platforms, financial brokerage platforms, and coming over. If you're coming over into sports, then there are software packages that try to maintain that level of software application, so that when you're actually doing your trading, you're still kind of doing things in a way that you would normally do it in financial trading. And the head of BetAngel, Peter Webb, actually alluded to that in the video presentation that's actually on the Science website, where he actually talks about the similarities between the different exchange platforms. And I believe it's on one of the Science website pages, if you haven't seen it already. So if you take a look, you should see it there. If you don't like technical trading, or it doesn't appeal to you, or it's not something you really want to do, then I believe there are some other sort of alternative momentum drivers that you can look into, like sofascore.com, inplaytrading.com, and even bet365.com. For every game, they've got some sort of ongoing stats analysis of what's going on in matches. In terms of using them, I couldn't really give you a vouch here or there, because it's not something that I've really used before. SofaScore I've used a few times to assess pressure in matches, weight of pressure. But if you actually look at forums, the jury's still out on momentum sites that provide stats on momentum drivers in games, because people have said they've seen so much sort of discrepancies and inconsistencies, and also the interpretation of what's going on in a game is subjective based on who's watching the game and feeding that information into the system. So it's just one of those things, you've got to try it, and if you manage to find something that works for you, then great. So the battle plan. So this is quite a important aspect, and this is where it really can make the difference for you in terms of getting consistency in terms of what you do in football trading, because of the fact that with myself, I have an approach which I call the sniper approach, and it's really just based on the key concept of trying to maximize your time in the market, so that you don't get sort of dragged into lots of long-winded battles with the market, which then sort of really eats up your emotional collateral. And so what I do, I actually divide my days into three categories. I've got premium hand days, I've got dogfight days, which I used to call something else. I used to call that proceed with caution days, but I call it dogfight days. And then you've got defensive position days. Now with premium hand days, it's just so funny. Why do people always have to just not just understand the general gist of what somebody is saying? A couple of webinars ago, I played a webinar clip from Dan Shapiro, who was talking about the concept of premium hands, and it's just so basic and obvious, and yet I get people who are just so they just have to take it the wrong way and have to just completely misunderstand, or always have to find something wrong. And it's just like, premium hand days just basically means that if you win your first 3 to 4 trades in the day, it puts you in a very bullish, very strong position to push on further. And a lot of the times, those are the days where if you're pushing on, you could mount up some of your most significant profit days of the week or the month, because of the fact that you're actually right in the middle of a forward trend or an uptrend. Yeah. And so winning your first 3 to 4 trades puts you in a very bullish position to maximize and push on. And so even if you push on with trade 5 and 6 and it doesn't go so well, you've lost money, but you've still got a very solid bank of profits that's sitting there, because of the fact that your reward to risk, your reward is greater than your risk anyway. So you can almost allow yourself to take the risk of pushing on to maximize if you are actually on an uptrend. The dogfight days are days where it's a bit of give and take. So within the first four trades, it might end up neck and neck 2-2. And those are the dogfight days where you're trying to pull away, but the market pulls you back, or the market is pulling away from the offset, but then you pull back. And so you can sort of push on, but just be mindful that, if you do push on and then get a couple more losing trades, it could ultimately take you back to a break-even day or just a small profit, which isn't bad, because at least you push on in the confidence knowing that ultimately, if you do go back down to zero, you haven't had a negative day, so you're still in control. And then the defensive position days are really just the days where you've just got to accept that you've lost the battle for the day. Now again, some of the cronies will come on and say, no, you're supposed to trade on. Every time there's a setup, trade. And so my question to them then is, well, what is overtrading? What is the definition of overtrading? So if you're supposed to trade every single setup of every single day, of every single month, of every single year, then what is obviously overtrading doesn't actually fit in your vocabulary, because the whole definition of overtrading is that you're trading too much, regardless of whether the opportunities are there or not. And so you've got to make a judgment call based on your lifestyle, based on expectations you have in terms of profit. You have to make a call as to how many trades you want to put on in a single day. And so for me, I know that, when I hit 3 losses in a row, for me, it's time to call it a day. And I'm cool with that, because at the end of the day, I know that I'm going to be winning more days than I'm losing. So, losing. And also the other thing as well is that what I find is most of the time, the majority of the times, when I start out with, 3 losses in a row, 4 losses in a row, what I've found in the past is that if I did try to trade on, ultimately what I would be doing is actually digging myself a bigger loss, because I'm actually in the middle of a of what I call a loss hurricane. And so rather than just trying to trade through it and incurring more damage to my account, I'm now much more content just to call it a day and know that I'm going to come back the following day. It's going to be a new day. Most days always generate a different sequence of events, a different sequence of wins and losses. So it's very, very few times where I will get 2 days in a row where I'm losing the first 3 trades in a row. And so because of that, it gives me the confidence to know that I can call it a day and move on to the next day. If you're happy to actually trade on and on, that is entirely up to you. But for me, it's all about minimizing my losing days, minimizing the losses on my losing days, and maximizing the profits on my profitable days. And that's the whole concept of cutting your losses short and letting your winners run. And I just don't understand why some people just have a hard time grasping that. As I said, the Science program was all built on different expectations and requirements, and one of them was to minimize volatility. Some people seem to like volatility in terms of their results, in terms of just trading on and on regardless of what's going to happen, because they're obviously saying, well, you don't know when a trade is going to be a win or a loss, so how do you know that when you've got 3 losses in a row that the next 8 are not going to be wins? And you're absolutely right, I don't know. But what I'm doing is I'm managing the things that are under my control, and control of risk and control of protecting my account is paramount, because ultimately I see myself now as a risk manager. So everything is underlined by, how does this protect my account? How does this protect myself? How does this minimize risk? Those are always at the forefront of my mind in terms of my decision making. Normal distribution, again, this is what I'm talking about. I'm saying that every day, most days, there will always be like a different sequence of wins and losses. And so, because the fact that my wins are normally 2 times bigger than my losses in terms of the pound value, so if my loss is £100, my win's going to be at least £200. It basically means there's a level of confidence and a level of assurance that I've got. But look at this, these are different sequences of wins and losses that come as part of normal distribution. Yeah, so obviously at the top, those are sort of great scenarios to happen, sort of akin to, I would say, premium hand days. But even looking at below, even if I start off with 2 losses, 2 wins can pull me back. And even if I get, most of the time, I have to admit this, most of the time, and this was something that I saw in the back test, most days I will get at least 1 win in the first 3 to 4 trades. And so what it basically means is that even if I do end up with 3 losses, that 1 win really takes the sting off the day, because the win is actually equivalent to 2 or 2.5 of the losses. So even if I do end up with a losing day, it's not something that's really going to make me not sleep at night. And again, this is the beauty of the reward to risk focus, in terms of making sure that your reward is greater than your losses. And that's what I've said below. The power of the reward to risk minimizes variance and losses and ensures that the majority of days each week will be profitable. So I know for each week that most days I will be profitable. There's been there were a few days in June which were the exception to the rule, but I knew that was a lot more to do with my attitude and the fact that I just didn't want to trade certain days, but I was just trying to still do it, and it kind of reflected itself in terms of the results. But I know that most days of each week I'm going to be profitable. So in a 7-day week, normally I would expect to be winning most weeks at least 4 days in the week. And I can't even remember the last time where I lost most of the days in the week I lost. I honestly can't remember. But what I find is that with a lot of tipping systems out there, with tipsters, they encounter huge amounts of variance. There's one tipster the other day who, he had 3-4 days of losses in the week. And it wasn't even a case that the other 3 days, which were wins, were massively bigger than his losses. And that type of variance, that comes down to the fact that, what they're doing is not really built around the foundation of reward to risk. It's more just built around, which system can bring about profits, and it's just about hoping that profits come. But certainly what I'm doing, it really does help to put a lid on volatility and variance, and so I don't have to. And you've seen that in the simulations. I mean, that's the whole reason why I keep telling you guys, do the simulations that I've told you, because the simulations actually convey. I mean, if I'm talking nonsense, then the simulations would actually disprove what I'm saying. But when you do the simulations, you see again that the number of losing days are very few and far between. And when you do get the losing days, it's nothing to lose your sleep over compared to the value that you get with the winning days. So in terms of my trading, I've kind of reached a stage where I would say it's a macro vantage point. So what I mean by that is it's got to the point where when I'm putting on trades now each day and each week, it's almost like I can now see the bigger picture. So getting losing trades, it's just no bother for me anymore, because I can actually, it's almost like I've decoded something which I've been working on for many years, and now it's just a matter of just running the machine and letting the machine do its job. So it's very much a macro vantage point. So when I get losing trades, I'm not really even thinking about it, because what I'm thinking about is where am I in the journey for this particular month. And so when I get losing trades, it's just a blip, it's just a pullback, it's nothing to get despondent about. And I think one of the other things I just wanted to mention as well, my late goal strategy is actually composed of 3 sub strategies. So there's 3 different angles or 3 different perspectives, and what kind of helped me to really almost decode what I've been working on is the fact that when I was doing these 3 strategies, I was when I was doing my analysis and my data mining, it wasn't really kind of stripping it down to the 3 strategies individually. I was really just looking at it as one late goal strategy, and it was only by stripping it down to the 3 different components or the 3 different substrands that it really allowed me to see the differences in behavior between the 3 different sub strategies, and helped me to understand the behavioral cycle that I see in terms of the reflection of wins and losses, and how streaks take place. And so over time, it's just built a sense of confidence that when I'm now looking at what I'm doing, it's very much from a top-down approach. So I'm looking down rather than being concerned about microscopic micro details of why an individual trade has lost or why a streak has happened, because I know it falls within the bounds and the parameters of what my expectation is. Okay, I just wanted to also talk about this, because again I brought this up in one of the previous presentations, but this is really just like an oscillator curve of peaks and troughs. So again, the way I trade is that what I'm trying to do with the whole battle plan approach is, with the battle plan approach, when I'm on a particular day where lots of trades are working out, I kind of see it as moving up the steep of a curve of an oscillation, and so I'm kind of moving up to a peak, yeah. And so what you're doing is just staying on it as long as you can until the situation reverses. And so if I'm getting like 4 or 5 trades in a row, I'll continue to trade 5 trades in a row where I'm winning. I'll trade and trade, but as soon as I start hitting a series of losses, then I jump off, because as far as I'm concerned, I've rode out that upward trend, and now I'm jumping off, because I don't know whether the downward trend is actually going to continue right down to the very depth of the valley. Because if I'm going to stay on and it rides down to the very depth of the valley, then it basically means that there's going to be a huge dent in a lot of the profits that I've generated on the upward rise. Yeah. Now I've got no way of knowing, because I don't have the gift of foresight. It's possible that when I jump off, that it could reverse and actually go into a new equity high. Yeah. But again, I'm managing what I want to manage. I'm managing my risk. When I'm on an upward trend, I know I'm on an upward trend, because it's just one win after the other, and there may be an odd loss here and there, but because of the power of the reward to risk, it means that I'm still going to hang on in there, because I know that even if I get 3 wins and then 2 losses, that those 2 losses are really equivalent to like 1 win. And so the whole point of this exercise is really to minimize volatility. Again, I just can't understand why people can't understand this, and it really bemuses me, because some people are saying that I should actually just stay on the downward slope because I don't know when it's going to reverse. But that's the whole point of managing risk. Managing risk is you're taking decisions and putting rules in place to basically manage your downside. Or else, I mean, suppose this line represented 15 losing trades in a row. I mean, not only are you having to deal with the fact that you've got a big hole in your bank, but you're having to deal with the emotional collateral damage as well. And that's another thing that people don't realize. It's not just about the money in your account, it's also about the emotional capital. And if you've gone through 10 or 15 losses in a row, you're not going to tell me that you still feel fresh and you still feel really up for taking the next trade. And so the protection of emotional collateral is important, because you don't want to get burnt out because of the fact that you're always having to sit through these really, really devastating downward trends in the name of trying to take every trade because you don't know when it's going to reverse. No, you take advantage of when it's going up, and then when it's going down, you jump off and then wait for the next opportunity to jump back on again. And that's reflected in the equity curve. And if you look at the equity curve from March to July, you will see that there were very, very, very few sharp pullbacks. There were pullbacks, obviously, because I'm not going to win every day. But what I'm talking about are the levels of pullbacks that I see in a lot of systems out there where the variance is, and that's why people are always talking about variance, because the variance factor is so high. Yet with myself, I've just found that variance is very, very limited and very muted. And that's because I've put into place these types of concepts, these types of analogies, these types of illustrations, which help me visually to understand what's going on. Now it's all about finding meaning in what you're doing. If it means gobbledygook to you, well, fair enough. Do what you're doing, but don't be unhappy with me because you see that I'm still making money. I was going to do a simulation, but I've decided not to do it because I've already done a simulation before. I wanted to do a simulation with the new angle that I'm working with, which is a much higher reward to risk, where the win rate is 50%, the expectancy is 0.75, and before it was 0.35. But by basically moving the goalpost further in terms of the reward to risk, it's meaning that my expectancy is actually going up in relation to the balance between the reward to risk and the win rate. And as the expectancy moves up past 0.5 as a value, it means that your system is becoming a very, very robust, very strong, and in terms of its ability to handle any sort of negative streaks that happen, which will happen. But there's no need to do that, because I think that's something that you could do just by going to Roll Dice Online and plugging those values in. So why have I got resistance, or why have I received resistance from certain quarters? And it's funny. I think number one, because what I'm doing and what I've done, it threatens the garbage systems and tipping services out there. There is a lot of garbage out there. People don't know what they're doing. People are guessing. People are getting positive results with 20 trades and thinking that they've got something that's actually going to work long term. People don't really understand the concept of risk reward and win rate. People are putting on trades whereby they're putting on trades where they're risking 4 to make 1, 5 to make 1, 3 to make 1, and then having to realize that every so often when that streak of bad luck comes, it actually clobbers them big time and sets them back again. So there's a lot of garbage systems and tipping services out there. So I just believe that what this does, it kind of threatens people, and it also puts the spotlight on why owners of system sellers, if they do show their results, only show the winning results and the winning days, and not the losing days and the losing trades. Anybody can show. I mean, you can get a blind man to basically click a button on Betfair and then find themselves in a winning trade, and it could be a huge winning trade. Yeah, so it's not about individual winning trades, it's about a consistency over a period of time. And I see so many people willing to show, can't wait to show their positive results, but then they go silent, and when they go silent, you have to wonder, well, what's going on? Is it the fact that they're getting losses they don't want people to know? And some will say, yeah, I've had a loss, but then they don't tell you what the value of the loss is. And that doesn't help, because if you're trying to assess a system, the win rate, the loss rate, and the number of trades, you have to understand what those values are. Or how on earth can you make any positive assessment or any sort of true assessment as to how effective that system is? It also puts a spotlight on those who are analysts and theorists but don't practice what they preach, and there's a lot of them. There's a lot of people out there that talk about theories and philosophies about what you should do, what you shouldn't do. Yet there's a lot of people that develop systems, but they don't trade. They don't trade, but they can tell you, they can sing from the hymn sheet, they can point this out and that out, but they don't trade. They don't practice what they preach. And that's why I'm not into arguing or debating people anymore, because it's a complete waste of time. Unless somebody actually shows me their results, ongoing results. I'm not talking about one great result for one day where they made over £1,000, because if they made over £1,000, I'm sure they're going to have days where they lost £1,000 or lost £500 or lost £600 or lost even £2,000. Show me those days as well. I also receive resistance because what I do, it provides a rapid profit sort of growth process, and what I see out there are sort of measly rates of returns. So as I said, I can point you to URLs where people who develop systems and are selling systems and selling subscription services are talking about having systems where if you've got a bank of £10,000, that by the end of year one you should have grown it to 20. Well, what's that? £10,000 over the course of 12 months? You've got to be kidding. I mean, I'm in this to make money, and I'm in this to really move heaven and earth to achieve what I need to. And that's probably why I have found a home with probability theorem, because when you see it being put into action by people in financial trading, and you see what they're able to generate with a bank of £10,000 over a period of time, it's frightening. And so for me, I know that measly rates of returns that are being touted are just not. It might work for somebody else, and again, I'm not trying to be big-headed or egotistical. I just know that where I am in my journey and what I want to achieve, and I need to have the right tools and the right environment around me to make it work. The resistance, it's also because I suppose this probabilistic systematic approach, it shows that it can be carried over into sport successfully, because the principles of an exchange are the same regardless of the asset class. So I had somebody on Twitter a few weeks ago saying that sports and finance are different, and I had to wonder, well, what planet are you on? It's an exchange. An exchange is basically a medium by where buyers and sellers come together. Buyers buy, sellers sell. There's an exchange. There's an electrical exchange. Somebody will profit, somebody will lose. Price comes down, price goes up. Price is dictated by opinions in the market. What is the difference? I mean, obviously there's going to be various intricacies, but in terms of the basic fundamentals, what is the difference? What I've just described, that's the same way that an exchange works with there's NASDAQ, with the FTSE, with S&P, with the Russell. You know, whether you're trading commodities or derivatives or indices or forex or cryptocurrencies or sports, the fundamentals are the same: buying and selling on an exchange, profit and loss. The fundamentals are the same. That you're looking to buy low and sell high. These are the fundamentals. And so that's why the ability to carry and transition over principles from finance into sports, it shouldn't be brain surgery. It shouldn't be something that facilitates a lot of heat and resistance, because it's principles that are applied to an exchange. And I don't know if it's the fact that a lot of people that get into football are gamblers or come from a gambling background and, you know, traditional betting background, and it's all about betting and recreational bets and over a pint of beer and that sort of recreational sort of mentality, rather than the mentality that you see in trading. Because most people that get into trading, it's not because they're doing it as a recreational thing where they're going down the pub on a Friday and logging into Betfair to place a bet with their friends and the lads. A lot of the times people get into trading because they actually want to make it an actual income source, an actual real income source. And so I don't know if there's certain nuances that I haven't sort of appreciated in regards to the difference in terms of what I see from financial trading as opposed to people in the gambling industry. But to me, as far as I'm concerned, it works. It can work between both, and there's no need to feel intimidated. And you know, some people just don't have the humility to accept that another approach can work, even though it's not their stable diet. And I've said it again, that what I'm proposing or what I've been emphasizing is just one aspect. There's many other people that trade that make a lot of money within football trading, and so all I'm pointing out is the strengths of what I believe are the strengths of what I'm doing, and how if you are somebody that has had constant frustration, then rather than spinning the wheel of going from the next betting system to the next betting system to the next betting system, why not give this a go? Why not give this a go and actually try and come from a different vantage point? Maybe you might find it works for you, maybe it doesn't work for you, but unless you give it a go, unless you sort of give it a go with a sense of humility and a sense of thinking, well, let me just forget how I've been pre-wired and try and do this based on what Mel has said and see if it works. And it's quite interesting because some of the emails that I've received have really reminded me of the whole situation in the medieval era with Copernicus, who, you know, tried to sort of emphasize the fact that from his research and studies that the sun was at the center of the solar system, not the earth. And this really caused a big issue with the Roman Catholic Church because of their particular belief system. They felt it was important that it was actually the earth that was at the center of the solar system and not the sun. And so he came in for a lot of persecution, a lot of criticism, but ultimately the results in the end proved, and there had to then be a general acceptance by the church, which ruled the state at the time, that this scientific phenomena within the solar system actually favoured Copernicus. And it's the same thing with myself. I mean, I've had people sending me emails telling me that what I do, I'm actually an outlier. So they actually come to the point. It's kind of funny, this journey, because when it first started, people were saying, you're trying to sell a system. And then when people realise that their bullcrap isn't actually working, because why am I selling a system? Have you seen anything on my website which says that I'm selling anything? Then I have to find something else. So instead of selling a system, now it's, oh, he's trying to get investment when his project ends. He's trying to get other people to invest their money, which is a load of codswaffle, because it's ended now. Am I asking for investment? and then they have to move on to something else. And so it just shows you how stupid and foolish people are sometimes when they just don't calm down and just, you know, have a sense of trying to understand what is actually happening. And so in the end I've had people that they've almost kind of run out of excuses. So the only thing they've come down to now is that I'm an outlier. So what I've done works. So there's actually an admission that what I'm doing is working, but some of them will call me an outlier, which basically means it's kind of like 1 in 10,000, and you know, another 10,000 people are not going to be able to do this, but I can do it. Some have said, well, it works now, but ultimately it will constantly, over months by months, start to decline and decline and decline and decline, which again, it's amazing what people will fathom to try and discredit, disprove, just because of the fact that they really don't have the balls or the humility to accept that what I'm doing actually works. And that's why I love stuffing my equity curve in people's faces, because that's the evidence. I mean, what else do you want me to do? That's the evidence. I mean, it's quite funny. I found this picture of Maradona and I was like, you know, should I just stick 2 fingers up at people? I mean, should I sort of go down to the level of Maradona to express my disconcertment with the way things are and how people have actually responded? Nah, I think that's going too low. What I prefer is this: sour grapes. So people have sour grapes, and we've seen it. I mean, one of the guys, I think he's at Trade on Sports. I heard that he probably talks about me every day like he has some love affair with me. So he's running his own subscription service, but he's mentioning Mel, he's mentioning the work I do, and it's almost like he has some sort of phobia about what I do, because how can you honestly be mentioning what somebody else is doing every single day? I mean, aren't you supposed to be focusing on what you're doing, unless maybe there's issues with what you're doing and it's not cracked out to what it's supposed to be? I don't know, but clearly you know, some people are sour grapes, but that's fine. That comes with the territory, and I'm fine with it, because at the end of the day it's results that count, not talk. And so it doesn't matter what I say, it doesn't matter what you say. We can debate 100 years into the future. The only thing that counts are results. So you can, you know, people have said, oh, your name's not really Mel, it's something else. Who cares? It's results that count. People have said, oh, you don't live in the UK, you live in America, because your server is actually a US server. Who cares? It's the results that count. Oh, you this, you that. Oh, used to appear in forums under different names. Who cares? It's results that count. And so it's people just focus on just such superficial things, and when they're hit with the reality of, you know, the truth is the results, they don't want to know. They rather talk about this, that and the other, which people that really are searching for truth don't really give a monkey's about superficial stuff. You know, all they care about is what this guy talking about kosher? Does it work? Does he show the results? Is there a scientific justification for it? If I do the simulations, will I see what he's talking about? If I try it, if I empty myself of everything I've been taught, get rid of all the garbage, if I just look at webinar 1 to 7, see what he says and try it, will it work? And if you give it a go and it doesn't work, fair enough, it wasn't for you. But I can tell you now, there's about 8 or 9 people that are liaising with me right now who are very, very happy people. And I can always tell by their temperament, their approach. You could just tell that these were people that were desperately hungry for something different, because they've spent, 5-6 years going around on the Ferris wheel and trying everything, and it just hasn't worked. So there's some sayings, the highest performers, the winners, respond by studying successful people and duplicating success. And as I said, what I'm teaching you, what I'm conveying, is not something that I made up myself. These are things that were taught to me by people like Peter Brandt, like Dr. Van Tharp, and others who are out there that are espousing the same views that I have. It's just the fact that they're doing it in an environment where they're probably not getting as much flack, because probability theorem is much more of a concept which people sort of fully understand within financial circles, and a lot of people will adopt it. But certainly in sports, it's just been really, really strange, some of the responses I've been getting, and I have to say, I wouldn't say it's the majority, it's a minority, but the minority are very vocal, and so when they talk and when they shout, you really do hear them. The 9 things to give up if you want to be wealthy. Well, stop complaining. So I stopped limiting beliefs, so the belief that I couldn't take £10,000, I couldn't take £5,000 and double it, I couldn't take £10,000 and double it without it having for a year or 2 years going by. So I had to really kind of just take down a lot of the limiting belief scaffolding that I had been taught within football trading, and just realize that I had to just re-engineer myself to look at things a completely different way. Blaming others, yeah, I used to do that. I used to blame system sellers. I used to blame Betfair for things happening beyond my control. But I just stopped blaming other people and just came to the conclusion that I'm in control of the things I can control. I can manage the things that I can manage, and I just need to do that as best as I can. And everything else that happens it's just a part of life. Yeah. Dwelling on the past, negative self-talk. That's what I used to do a lot, which always used to be a hindrance to me moving forward, because negative self-talk, dwelling on what's happened in the past, can then impact you in terms of making that split decision to actually take the trade when you need to, and then you dwell on it for 5-10 seconds, and then something happens and you've lost out on the opportunity. Resistance to change is a big thing. You've got to be open, you've got to be humble. And if there's anybody out there who has another strategy which actually brings back even more return over a period of time than what I'm doing, and they have something which is better on all attributes, I would be willing to look into it. I'm not going to just say that what I've got is just the end, because I know there's going to be other people out there that are searching for their strategy, their nugget of gold, and they're going to find something which I could never find or would never find. And so resistance to change and being open is so important. The need to impress others, well, I used to be quite egotistical about this a couple of years ago, and then life taught me a real harsh lesson. And so I've realized that it's not so much about impressing others, but it's about helping to educate others. I mean, I could show you my results for the next 6 months as it ramps up, and start getting compliments from you that, wow, Mel, you're doing really well when you're hitting £1,000 days regular. But it's not about that. It's not about that. And the need to always be right. I've realized that I don't always need to be right. I can deal with having a win rate which is 55%, 50%, even 45%, because I've realized that it's not about being right, it's about making money. And you have to understand that there is a distinction between the two that needs to be understood. Obviously, you need to win, because if you only had a 1% win rate, then clearly unless your reward to risk was 1,000,000 to 1, but certainly you need to be right. We know that. But what I'm saying is that the need to be right, so you're having to chase something that's 70-80% to make you feel comfortable, those things are of the past as far as I'm concerned. And I don't need others' approval. I really don't. So I mean, I'm talking to you about what I've done, and whether you accept it or not is totally your decision. But certainly for myself, I feel that I've actually done some good by sharing something that others can take on and duplicate and move forward with. So I don't need others' approval, but at the end of the day, I feel that I've done some service by not charging and sharing information with you, which I didn't need to. I could have just kept it all to myself and just, you know, sailed off into the sunlight. But I kind of felt that there were some people out there that I just knew would gravitate towards this, and it's been evidenced, you know, that there's 8 or 9 people. I say 8 or 9 because I forgot to count and I couldn't remember if it's 8 or 9, but there's 8 or 9 people that have approached me directly, and I can see what they're doing. They've shown me spreadsheets. I mean, one of them, you know, I call him a clone because I saw his spreadsheets, and at first it almost looked like my spreadsheets in terms of how he did his analysis. He even had a spreadsheet for Roll Dice Online to do simulations. Even some of the leagues, he was missing out some leagues and doing other leagues, exactly what I've been doing. And I was like, you know, is this guy a stalker? Is this guy got some access to my webcam where he's seen what I'm doing? And we had a great laugh about it. But again, it's just so inspiring to know that there are other people that have helped. And if it's only those 8 or 9 people, absolutely fine with that. I'm not here to convert the whole world, but I know that as long as some people have been helped, then for me, you know, I feel that the journey has been worth it. So my website is sciencesharetrading.com. It's going to remain as is. The only difference is that I actually uploaded my results for the 1st of August. Because I'm caught in this routine, I actually forgot I was supposed to end it the end of July. So in fact, the 1st of August actually made £300. So, you know, the momentum of results is still favourably continuing. But I'm not going to update any more results because I didn't really want to be continuing with that level of responsibility into August, September. But what I may do is probably, you know, come the end of the year, I may come back and give an update on where I am, how things have moved forward, and give you an insight into, you know, how my income has racked up based on the various things that I've talked about. But the website will stay, so all of those web pages will remain as is. The only difference is that the update of daily trades has actually stopped as of the end of July. But with the website, if you do contact me through the website by email, then I will still answer your emails. I just won't be answering Twitter because I just don't want that level of responsibility anymore. I've said my piece, done what I've done, and people can go through the history of Twitter to see my journey. But I think I've put on more than enough with the webinars and the answers to questions for people to get a good grasp of what they need to do if they want to sort of come on this journey with me. And as I said, there's 7 webinars in total, including this one. So if you are new, don't just start at webinar 6 and 7 and then start asking questions that are already answered in webinar 1 or 2. And again, I think this is good training. You know, those people that really want it and are hungry and are willing to sort of roll up their sleeves and put the dirty work in, those are the people that are going to go to webinar 1 and say, you know what, webinar 1, webinar 2, webinar 3, webinar 4. But people that just want, you know, fast food mentality will just go to webinar 5 and start making all kinds of assumptions about what I'm saying without contextualizing it in view of the fact that there were previous webinars. So if you want to really do this seriously and treat it seriously, start with webinar 1, webinar 2, 3, 4, 5, 6, 7, because I would say 80% of the time it's going to answer questions that you had. But just have the patience to go through them one by one, because the whole reason of me putting the webinars is so that when I'm gone, there is still something there is some meat on the bone that you can still contend with to help you in your journey along. So these last 2 sayings, sometimes the people around you won't understand your journey. They don't need to, it's not for them. But for the 8 or 9 that are working with me, in terms of you're following me on this journey, this is for you. You understand. You had the mindset, you had the tenacity, the strength of mind to say, I'm going to give this a go. I may not understand everything, but I just believe that things will fall into place, and let me just take that level of faith, that step of faith. Mel's not going to reveal he's not going to provide a tipping service, he's not going to reveal every single thing he does, because that's his proprietary information that helps him to get an edge on the market. And everybody, I'm sure people will be appreciative of the fact that there's a certain intrinsic worth attached to my experiences and what I've done. But these 8 or 9 people have rolled up their sleeves and found that by developing their own methodology based on late goals, and they've managed to put something in place which is actually starting to bring back results that they've never had before in terms of consistency. Most great people have achieved their greatest success just one step beyond their greatest failure. And I've added this really just to say that there were many times, 2, 3, 4 years ago where I nearly quit. I really did. I just kind of accepted that this thing doesn't work for me. It's a pile of crap, and I just need to just relinquish all connection to it, because I'd reached a point where mentally I was completely fatigued. But something inside me, I don't know whether it's just the refusal to quit or a refusal to accept defeat, or just an understanding that there must be something out there that to make this work. And then I found what I found with financial trading, and saying, what, if I just take these principles and concepts and take it back into where I really love, what I really love, which is sports and football, can I really make this work? And even then, armed with all the knowledge, it didn't happen from day one. Because again, you can have all the knowledge, but if you don't have the psychological strength to embrace dealing with uncertainty and dealing with strategies that are actually counterintuitive, you could still find yourself kind of like running around on a Ferris wheel. So there was a process I had to go through, a process of tribulations and trials, and crawling on my belly to get to the point where all of a sudden, piece by piece, things started to come together. And then I started to get certain eureka moments. And then, my last eureka moment, I think, came in June, where I'm looking at the data and suddenly I'm like, God, if I just break it down into the 3 different substrands, and then I could see how they intermesh with each other, and incredible, unbelievable. And it's almost like you're kind of metamorphosing from a caterpillar into a butterfly. So if you're at the point of your journey where you're about to give up, don't give up, because you could be just round the corner from making that 1 or 2 changes you need to really turn things around. So it's something which I kind of believe that my way isn't the only way, that there are an infinite number of ways to make money in football trading, and you just have to find the one that works for you. But don't be limited by people that want to ramp you into subscription services because they just want to get your money. Try and develop something for yourself, or if you are in a subscription service and they've got some type of methodologies floating around, take it and then try and do your own thing with it, to really see if you can actually take it to the next level. ScienceTrading.com is the website. So it's been a pleasure. Again, it's been a journey. Many didn't think that I would be here speaking at the end of July. So now it's the part which you've all been waiting for. It's the pitch. So basically get your credit cards out, debit cards. Only joking. Those people who thought that's what it was all about, well, they're the ones that are looking like stupid fools, and that will teach them a lesson for trying to assume something instead of looking through the smoke and mirrors and actually seeing that all I was trying to do was talk about my journey and give people an opportunity to learn and take something from it that they could apply for themselves. So great speaking to all of you, and as I said, I won't be responding to any sort of Twitter messages for now, but certainly I think probably come November, December, I'll be coming back on, probably to do a webinar and just give you an update as to how things are faring and holding up. All the best, and again, it's been a great opportunity. Thank you for your support. Most of you, thank you for your support, your kind words, your best wishes. It has been a pleasure going through this journey, and I just hope that, you know, even if there's one or two things that you can take which can help you in terms of your path and your journey, I hope that I've helped to make some sort of contribution. And again, it's been a pleasure. Bye bye.